Welcome to Wealthwise with Maggie. I'm Chris Maggie, and this is Kirk Agus, and we're glad to be here each and every week. We love doing what we do. There's a lot that we do here to help people, educate people, and provide solutions in the financial area. So, Kirk, let's welcome you, by the way.
Well, thank you very much. Yeah, not the only one on the show here today.
That's right.
Chris,
We got Jacqueline. Sorry.
Chris just is so excited for this topic. He's just getting right into it. He's, doesn't mind.
You know what? Thanks for coming, everybody. I'll see you all next week. Wealthwise with Chris. How about it?
Well, Chris and Kirk, that's going to be a tongue twister for me.
Yep.
But how are the two of you doing? What is new in your worlds?
Oh, man. It's always changing, right? A little bit of R&R this past week. I had to get out of town to go to Oklahoma. That's on my wife's side of the family. So we had a trip there. We got 2.5 weeks left with the kids, and then they go back to school, for crying out loud already. So we're getting down to the nitty gritty of things.
Wow. So they start school in mid-August?
August 10th, I believe we are. Yeah, very early.
Mm-hmm.
Wow. Is that like a Florida thing or?
I believe so. I used to be the Wednesday after Labor Day. That was growing up in Michigan, and that's still the case up there, but down here it's a different story.
Wow. But it's not considered all year, like year-round school.
They had 10 weeks off for the summer. Okay. So this is week 7 that they're in right now. No, this is week 8, I believe. This is week 8. They have 2 more after this.
Wow.
Yeah.
Well, that's exciting. Chris, how about you? You have some exciting kid news too.
Yeah, absolutely. You mentioned a couple of weeks ago, you asked the word that described me, I guess.
Yes.
Multifaceted, I guess. Can do a lot of different things, work, right? Coaching a baseball team, kids. But speaking of baseball, my son is an all-star team playing 11. So we're on the road to all-stars and won districts and sectionals. Now went to the state of Florida tournament. So it's pretty exciting.
2 years in a row?
2 years in a row. So we're pretty excited about doing this, and let's keep going if we can.
Okay. Have you been the coach for both years?
I have. And so it's exciting bringing the same kids along the way. Kirk coaches too. He's done hockey. So we understand the team environment, how, it's really important to bring these kids along the way. And as you keep going, the team strengthens and you feel confident, and a lot of cool things happen.
Mm-hmm. Yeah. Well, just a reminder, it is a testament to you as a coach too. So don't forget that. That's really impressive and very exciting for all of you. But hockey's not in season. So Kirk, what are you doing now?
Believe it or not, down here, I'll tell you what, it almost turns into a year-round program, hockey.
Really?
At the high school level, my son just finished up spring hockey last Friday. There's a 2-week period here where nothing's happening. We'll take them for some skills training, but then they have tryouts that begin the first week of August, and they're back on the ice preseason 2 weeks after that. And the season will continue all the way out till like March.
Wow.
But yeah, it's so we got a small break, right?
Mm-hmm.
But I took a break from coaching this past year just to be a dad and be in the stands and cheer. And I tell you what, that's hard. That is very difficult. You gotta bite your tongue. And my wife's always hitting me. She's like, "Would you just stop it? Stop it. Just enjoy, watch the game."
Yeah.
And then when we do a lot of film watching though, because I record all this stuff.
And then when he gets off the ice, it's done with the conversation. I think that's the hardest thing too.
You know what? I don't bring it up. I wait for him to bring it up.
Okay.
So those car rides home or anything like that, I wait because I don't want to drill down on anything. So if he brings it up, then we'll get into it. Sometimes it's the next day. So you know how that can be.
Yeah, absolutely. Well, it's great to hear about sports and just kid life. It's great to talk with you guys and be on the show today. But I think this is actually a really exciting episode because who doesn't love the word tax-free? I mean, honestly, if we could limit taxes, I would love tax-free options, especially for my retirement. So where do you guys want to start with this today? Kind of what does tax-free mean?
Well, this is a loaded question. I mean, people are seeking tax-free. I mean, taxes are our biggest expense, and people do what they usually do, and then what they've been taught to do is save, put money in a 401k, an IRA, just keep pounding money into that. The misconception is tax rates are going to be lower in the future, and just sock away money as you can. Get a tax deduction today, so all your money in the future is taxable. But what do we see, Kirk, when we see this all the time, that these IRAs, these 401ks are becoming 500,000, 800,000, $1 million, $2 million,
Wow.
and what they are infected with taxes, and people just really just don't know that they're going to have a rude awakening, because this is a big tax time bomb. So we're talking about tax-free income, because we're taking a step ahead and ahead and ahead, looking forward, so that the people right now can discover that you can have tax-free income if you just put together a plan, right, Kirk?
Correct. Because Chris just brought up a great point when he was talking about, when you retire, we think we're going to be in a lower tax environment, right?
Mhm.
That's the traditional thinking, the thought process behind that. What you're not taught years ago when, as Chris said, you're socking away money into the 401ks and it's all tax deferred, is what is the tax rate actually going to be when you do retire, or when you need to start taking money out of those accounts, or when you're forced to take money out of the accounts with the required minimum distribution. We know what the tax rates are right now, right? Historically low, but what is it in the future? What is it at age 73 when you have to start taking RMD? Some folks are going to fall under the 75 age bracket for RMD. And as Chris always says, it's a question mark tax rate, right? So what are you doing about it?
Right. Yeah, great questions. And I think too, it's all about timing here, because taxes are going to be there. It's either being taxed now, being taxed later. When do you want it, or do you want it to be under the discretion of the government by saying, nope, you have to take this money out with your RMDs and get taxed now. And so why don't we want to have control over that, and control over where our taxes, when they're going to be paid. So let's start with maybe an option on life insurance. I know you guys said that there's an option with life insurance that might be able to limit some taxes. How does that work?
Well, this is really unique. There's a lot of different ways you can go about. Kirk's going to elaborate on another topic, and I'll talk about the life insurance. There are ways to structure a life insurance policy these days to become your own bank. You can put money away in using life insurance. And a lot of people think of life insurance as a death benefit. They have to die to get the money, but things have changed over the years. You can fund a policy, get the lowest amount of death benefit possible, so you have cash in the policy that's accumulating, and you can take the money income tax free. What's really unique is that you can leverage your money. What do I mean by that? Well, there's different ways that you could power pack a policy by using financing it. You can finance the premiums, where you can keep your money that you have, keep letting it grow, but you can use a bank, and we can finance money going in to make these policies even stronger. And what's really unique, if you structure it the right way, we look at the illustrations, and you can have your own tax-free pension, and you can set up today so that in 10 or 15 or 20 years from now, you have tax-free money coming out for the rest of your life. And you don't have to worry about a taxable event, or what Kirk said that I always talk about is a question mark tax rate.
Yep.
You can eliminate that, and you can be in tax-free land. So, think about this. You go buy a house, right? What do? You go to the bank and you get a loan. And you finance it, right? You go buy things. What do? You put on a credit card. You kind of finance it, right? But hopefully you pay it off every month. But the same thing we do with your retirement with this unique feature. And it's really interesting, because you can leverage the amount of money going into your retirement now, so you can have more premium going in. And then in the future, you can have more tax-free money coming out. So if you have any questions about this is one of the ways that a lot of grandparents are setting up their own kids or their grandkids for future tax-free income, and also leveraging their money in a lot of unique ways. So if you're interested in this is a great way to get some more information. Just give us a call, and we can help you with one of those ways.
I'll add to it too, because life insurance, when a lot of people start talking about life insurance, some people wiggle in their seat, and they don't like to talk about it. They're like, oh, that's a dirty word, life insurance, right? Because I want to reiterate what Chris said, is if you picked up on it, traditional life insurance, as most people think about, where someone has to die for someone to receive the benefit.
Yes.
And so when Chris is talking about using it as a living benefit, that's a completely different animal, right? And it's a tax-free bucket of money now and in the future. And that can help lower an individual's taxable liability. I just did a seminar yesterday. I was hosting an event. We talked tax, we talked Roth conversions. We'll get into that in a moment. Social Security, estate planning. And often at times when I speak about estate planning, I say the forgotten piece to this is the taxable part of your estate.
Mm.
How is it affecting you as an individual while you're alive today? And how is it going to affect your heirs down the road? This is one great example that Chris brought up when we start talking about transferring wealth to your heirs in the most tax efficient way. As you said, Jacqueline, who doesn't love tax-free?
Right? Absolutely. So some words come to mind as you guys explain this is, kind of the comfort, the consistency, what you're talking about. In other words, do people use this kind of as a savings account? Is that how you kind of use it?
If you structure it the right way, and that's where not every financial advisor understands how to do this. We are set up uniquely, and that's what really separates us from a lot of other advisors out there, is that we do tax planning, we do insurance planning, where it's a fiduciary, we actively manage money in the market. We have attorneys that work with us. We do complete planning, Medicare planning, Social Security planning. So we do a lot of different things. So what's really neat about this is that, you can use it as a savings vehicle. You become your own bank. I mean, wouldn't you want to have an account that you can go access? What if you need a loan? What if you want to go buy a car? Instead of going to Bank of America or Wells Fargo with a credit union and getting a loan and charging you're paying the bank 5 or 6%. What if you can borrow from yourself? Wow, that's pretty cool.
Yeah.
Become your own bank. And the interest that you pay back to yourself. That's pretty unique. So who's talking about this? Well, we are. Why? Because it's an option for you. And that's just one of the ways with tax-free retirement using cash value life insurance. And, you want to get the right education on this, and we can help you and we'll steer you in the right direction. That's one of the ways. The other way is we kind of all know about a Roth IRA, maybe a Roth 401k. But, Kirk, I think it's really important. He's going to talk about the Roth conversions. But, Jacqueline, that's how you can do it.
Yeah, let's start with maybe explaining, just for our listeners and viewers who may not know, what a Roth IRA is and how it's different from a traditional IRA.
Sure. So Roth IRA is tax-free money, right? And a traditional IRA is tax deferred. So Chris brought it up earlier. We talk about 401k, traditional IRA, 403b for our teachers. Federal employees have a TSP. These are examples of tax deferred accounts. So money goes in, you get a tax deduction now, today. In the future, when you take money out is when you have to pay the tax on the withdrawal, or when you are forced to take it out on the required minimum distribution. If you have a Roth IRA, it's tax-free. Well, how does it become tax-free? Well, the money that goes into a Roth IRA, you pay the tax up front. Okay. Now, once you've done that, all the gain, all that growth inside the Roth IRA grows tax-free. Therefore, in the future, when you take money out, you've already paid the tax, it's tax-free. So you have two different avenues to go down. Now, you have to be careful too, though. I will say this. There's a what's called a 5-year clock on a Roth IRA.
Okay.
Just a quick little excerpt on that. If you were to open up a Roth IRA today, the clock is going to revert backwards to January 1 of this year. So 5 years will begin, meaning what? The money you put in, you pay the tax up front. Now, you can take that out because you already paid the tax, but all the gain from the money you put in, you have to wait 5 years before you take it out without being assessed a penalty. So the bottom line is you have two choices. You can stay on the IRS plan, which is just deferring the taxes as long as you possibly can until they force you to take it out. Or you can utilize a Roth IRA, Jacqueline, and create tax-free wealth so that in the future, when that question mark tax rate shows up and the tax rates go up higher, doesn't matter how high they go, you're in tax-free world.
Yeah. Well, and it sounds like, what I like to say is taxes are on sale right now, is what I say. And what you're also saying with a Roth is you're trading the tax bill now for no tax bill later. And are there RMDs with a Roth?
No, there isn't. And that's the beautiful thing. You're not required to take out a distribution. But even if you do take one, it's what? Tax-free. What's really interesting about this whole thing, you mentioned taxes are on sale, right? Things are on sale. We buy things when, Jacqueline, you should know this.
When it's on sale.
When they're on sale.
Girl,
so you
now.
know. So anyway, with that said, why not buy the taxes now since they're on sale? So think about this, Kirk mentioned, we don't have farmers here. My wife is from Illinois, and my in-laws have a farm out there. So they grow crops and stuff. And when I go out there once a year, it always hits me hard because I see what goes on. He plants the seed, and then months later, there's a big harvest. Those corn stalks are growing, right? It's the wheat, right? All that good stuff. So you see it. That's the harvest. So the way I make this simple is, would you rather pay tax on that small little seed to have a big harvest tax-free? Or would you rather pay tax on the other way around? And that's it. So we would like to pay the tax now so that our harvest is income tax-free. So to buy things on sale, we can do that right now with your investments and your accounts by doing a Roth conversion.
I love Roth conversions. We spent, a good 20 minutes yesterday at the seminar talking about Roth conversions, and it was an engaging conversation, Jacqueline. And so for a lot of people who may not understand a Roth conversion, you may have all of your money tied up in an IRA, a traditional IRA, right? The tax deferred, but you want to get into the tax-free world. So you can convert your traditional IRA into a Roth IRA. And in order to do so, you have to pay the tax on whatever it is you convert. Now you can convert however much you want, however often as you'd like, and there is no age restriction on when you want to convert. The only restriction is if you are satisfying RMD. Okay, if you're at RMD age, you have to do the RMD first before you can do a conversion. So it's the RMD first rule. But anything that you convert down from IRA to Roth IRA, you got to pay the toll, right? You pay the tax to get there. So as Chris said, paying the least amount of tax on that small seed that goes in there. When we do the Roth conversions with clients, we run a tax analysis at the same time, right next to it, side by side. Why? What are we doing? We're showing the client how much tax they would have to pay in order to make that conversion. And when you do this, Chris, it's really fun to watch because sometimes the clients look at it, Jack, and they're like, I can pay that. As a matter of fact, you know what? I can pay a little bit more. Let's increase that a bit. Or they might dial it back. The beauty is you're in control of the amount of tax that you can pay. So we always say, why not be the one to control the tax? Don't be controlled by the tax. Right?
Yeah. So when you pull money from, a traditional and put it into a Roth with that Roth conversion, how does it affect your income bracket or your, income levels, basically?
Well, that's what it is. Kirk mentioned a great analogy, to get over the bridge, right? We've maybe been to California and the Golden Gate Bridge, New York. To get over the bridge, you got to pay the toll. So it's fine, but you're on the other side and then you're in tax-free world. So it's ordinary income when it converts. So if you say you're making $50,000 and you want to convert 100, okay? Well, now you're paying tax on 150. So then you'll have more tax to pay. But what Kirk mentioned, a great point, and that's why we do this in front of the client, with the client, and that's beautiful because then we can do this together. That's why we're here, to help you. So Kirk mentioned a great point where he says, say the tax liability is $12,000 on that $150,000. Well, you might say, well, I got $20,000 in the bank that let's pay the tax on. So we could pay $8,000 more in tax, which probably means I can probably get another $50,000 out of the IRA and put it into the Roth, and then I'm home free. So I just converted about $150,000, had the tax to pay on the side, and now my $150,000 is all income tax free.
Wow.
So we're aware of the brackets and the ages and
what
we need to do, if that makes sense.
And Kirk, you mentioned, RMDs come first. Is there an option to convert your RMD to a Roth?
No, you got to take the RMD. Well, here's what you could do. You have to satisfy the RMD. You're paying the tax on that. You can't just plop that and use that as a way to convert into the Roth and say, oh, look, I'll use my RMD to convert inside the Roth. I'm done. No, you can't do that. IRS has to mandate you to take out a certain portion every year once you turn 73, or as I said, In 2033, it's going to go to age 75. So you have to satisfy that RMD. So then a lot of people say, well, what do I do with the money that's left over? I took out what I'm supposed to take out. I paid the tax. Now what do I do with it?
I don't need it. Yeah, I don't need it right now.
You can do whatever you want with it, because now at that point, what's left in your hand, so to speak, is tax-free, right? So, I mean, you can reinvest it if you want. You can. There is that option. You can reinvest it, go take a trip, do whatever you wish. But there's a lot of unique things, which another way, I want to piggyback on the first part that Chris brought up a little while ago when he started talking about life insurance. When someone's in a position like this, Jacqueline, where they say, I don't know what to do with the RMD at this point, what after I pay the tax. Well, is long-term care a concern to you? Oftentimes it is. Yeah, for some people it is. You can utilize life insurance as a way to create a bucket for long-term care. Why not use that money left over from the RMD? We pay the tax. We fund a life insurance policy that has a long-term care rider component to it, plus the death benefit that's going to pay tax-free to the heirs. And now you are, you're satisfying multiple needs because of the money you already had to take out. We call that insuring your IRA.
Or what we call it, rescuing your IRA.
I like that one.
There's beautiful things that you could do. So, these are strategies. Within 20 minutes, we're talking about tax-free lands, right?
Yeah.
So the big question that we have is, is your current advisor, is your current CPA, is your agent, are they talking about this? Is it no? Well, what's going on here? So, that's what we do. So at Maggi Tax, visit our website at maggitax.com. That's why we do these podcasts, Wealthwise with Maggie. Why? Because there's so much to talk about here. This is just one of the components that can help all our listeners from the tax side, from the insurance side, from the investment side, from the estate planning side. Gosh, there's so much to talk about. I mean, we can go on and on for days. That's why we do our radio show, and that's why we do our TV show. And with the podcast here, it's just more information for all the listeners out there.
Yeah. Cheap plug. Visit the website. You can go to the seminar page. If you go to maggitax.com, click seminars, and you'll see where we're going to be coming up here in the next month.
Okay, so now since you guys both gave plugs, now I have to. Please go to Apple Podcasts, Spotify, or Amazon to find all of our past shows. They're also on the website. You can just search Wealthwise, but my favorite is head to the YouTube channel so you can watch us. And there's a few shorts there too. So thank you both for being on the show today. Any final thoughts?
Glad to be here.
Hopefully we see this guy with his team in Pennsylvania here at the Little League World Series.
Oh man, we're getting there. We'll see. Hopefully keep this ride going.
Well, thank you. That does it for this episode of Wealthwise with Maggie, with our host, Chris Maggie and Kirk Agus.
Thanks, Jacqueline.
See you, Jacqueline.